So, hello everyone, officially very warm welcome tonight to part 3 futures of our futures course practical application. Well, we basically let me just first say the date. Today is the 14th of July 2021 and it's 6:33 p.m. in Dubai. So let's just continue basically building, creating, and filling our radar screen. So yesterday we spent quite a lot of time, right, with the equity indices. How also in terms of position sizing, in terms of how to create the unadjusted symbol. We had a little bit of confusion about when it came to adjusted continuous contract and unadjusted continuous contract. I hope we were able to clarify this yesterday, but I will do a little bit of explanation maybe tomorrow or next week. I can already tease that I'm pretty sure we cannot cover everything today and tomorrow since it lasts longer than expected, but it's okay. We gonna take our time on these futures topics because this is really important. Now, what we're going to do today is basically, I really want to fill in the radar screen and completely, as much as possible, complete the radar screen with all the different markets and asset groups, so to say. So we're not going to place like we did yesterday, right? You can do this yourself. Once you have the symbol in there, you can place an order yourself on the matrix. You see the tick value, then you can calculate a point value if there is a point value, and so on and so forth, right? We don't have to do this. I hope you agree. We don't have to do this in each and every product. I think the process on how to create that radar screen is more important. I mean, it's both is important, but I think placing an order then on the matrix, I think you can handle. I hope you can handle yourself, right? I hope you agree with that, and we start now. Continue with the interest rate group. So we have basically now. Let me always go here on the TradeStation website where you see, by the way, let me go to the starting page. I just saw today and they're advertising today. So I think this is also brand new. Look at this. So introducing micro crude oil futures. So you have now, literally you have now the normal crude oil futures, you have the E mini, and you have the E micro crude oil futures. So crude oil futures. So you literally have kind of standard lot, mini lot, micro lot now on crude oil. And I think and this is quite new. So I think they're going to the CME group, right? I think that's the also the future in futures, right? That they on all these very popular products, they introduce standard, mini, and micro because they see the potential in the CFD markets, right? In the retail world, because nothing is more trendy right now than trading the markets, right? So if they introduce minis and micros on more products, they get definitely more retail customers. So I think this is the future also in the futures market. So we have to then obviously always double check and cross check if there are new products coming, new minis, new micros, and then we update our radar screen accordingly, right? I just saw this today. I think I wanted to show you. So we're gonna add obviously today already the micro crude oil futures as well. But now back to interest rates. So one more thing that I was doing a screenshot. Let me just go here. I was checking. So here, let me get it in. So we talked about the subscription fees for the exchanges, right? So I was wrong. The Eurex, the European exchange where you can trade the German products, the live one is only $18. So this is something you can really think about, or we can think about as a campus to subscribe to this live data, and then obviously plan out trades for the Eurex market. So we can definitely also do a session where we basically, because we have a lot of Eurex markets as well, just to cross-check the charts and see if there's any kind of correlation, especially to the all the interest rates, treasury notes, bonds markets, if they're similar to the US or if they're like their own kind of animal, and then basically if more trading opportunities, basically if they are not really basically correlated products, right? So Eurex $18. So, but obviously the more interesting exchange, the ICE Europe commodity futures exchange, it's freaking expensive, but that's the one that is most interesting, because that's the one. So $126, that's the one where we can trade live, as we said, right? All these softs, coffee, cotton, frozen orange juice, I put in brackets. I don't know about that one. Never checked this one out. Cocoa, and of course sugar, right? So I'm pretty confident that I'm going to subscribe to ICE. I'm not yet subscribed to ICE. I'm still trading sugar like you guys, most probably on Oanda. But if I looked at the fees that I paid on Oanda on my position this year so far, it's kind of ridiculous. So I'm definitely gonna switch over to futures again. But the $126 is just for a whole year. To get like 5 products live data is quite a lot, but it's completely up to you. I think if you trade a decent amount of, if you trade a risk size per trade that is more than $1,000, then I think it's something that you should also think about, because obviously a sugar trade with 3-to-1, 4-to-1, or 2-to-1 is already easily compensating the subscription fee here, right? Something you have to think about for yourself if you want to subscribe. So we definitely at some point going to subscribe, not yet, but in the next, I would say, in the upcoming weeks, and then we also do the analysis on these products, like in terms of adding it to the radar screen and all these kind of things, right? But in this kind of class now, in this course, we focus on the CME markets, because there we have, everyone has the live data and it's for free, right? All right, so as we said, no Eurex, no Euronext live markets. So now, before we go to the currencies, we go to the interest rates. So here we have already in our list the 5-year, the 10-year, and the 30-year bond. What we're gonna add on in our list is the 2-year, and then we just look quickly at the chart, at the correlation, if it makes sense to add the 2-year, because what I would assume is that anyway, to a certain extent, they're all correlated. If one collapses, all of them collapse. If they rally, all of them rally. But of course, they will have a little bit of different behavior, especially 30-year versus 2-year, right? but I think they are quite similar, but we're going to check the chart, and the 30-year and the 10-year are quite similar. But we will check the chart just quickly, the monthly, to see, hey, are they similar or their own kind of thing, right? So now, on these treasuries, so guys, the first one we do together, and then the rest is very simple, right? So lead me through the process. How do I find now? How do I find the symbol for the tradable contract for? Let's start with the 5-year. What do I have to do? All right, bar chart check front month, perfect, right? What else can I do to check the front month? What else can I do to check the front month? Perfect. So add TY. So add TY. Wait, how do I have to, let me make this a little bit smaller and the chart a little bit longer, so otherwise I don't see. That's of all right. So here it's why don't I see it? It's because it's here, but it's the September one, I guess, right? It's in brackets. It doesn't have. I tried. For treasuries we need bar chart. Okay, that's funny. All right. So we go to futures. We go to financials. And there we have all of them, right? So 5-year, September, yeah, it was in bracket S. It can only be September, right? So S, September, it's U, right? Don't get misled by the first two symbols, ZF. This is for maybe a different kind of broker. The symbol for the 5 years, we have TY, right? You see this on the TradeStation website. So it's September. So surprise, surprise. So the back months we know already is December. All right, you see that here also December. So two contracts are being traded right now. The September and the December. Even though the volume, you see that the volume is very low on the back month. So everyone trades the front month. So it's always for each and every treasury. It's September and December. So very quick for us to basically complete the radar screen. All right, me. All right. So what do we have now? FV U21. TY U21. USU 21. So let me add already as we said, let me add here for us to trade. Where do we have it? The 2-year TU, right? Because look at the margin requirement is super, super small. And I assume also the tick value must be super small as well. So let me add this here. So how do you add something here on the radar screen? You just click on one of these black boxes, go to data, and then add blank row. So to add another blank row on top of it. So what did we say? TU, right? TU U21. right? So now we do here the same stuff, data at Planck row, TU, what is it here now? What is it here now? What did we say? TU set, it's December, right? It's December. TU set 21, right? You guys correct me. F we set 21, TY set 21, and US set 21. So now we have the front month and we have the back month. So now, ladies and gentlemen, let's first look at the correlation. Let's just quickly look at, just out of curiosity, at TU. At TU. All right. At TU looks like that, and at TY. All right, you see they look already different at US. All right. And what else are we missing? At FV. All right, you see, as expected, if we look at TU and at TU, the 2-year and the 5-year, they look kind of the closest, right? So they're kind of correlated, not exactly the same. So yes, definitely something we can trade in the future as well. If I click at TU and look at the monthly demand zones, they look all quite neat, right? Definitely something clear uptrend, right? Something that we can definitely consider. So in terms of, I'm also not going to do this today because this is something for you very easy that you can do. If I add now, I mean, I'm doing it now for this one, but for the rest, you can do yourself. If I have to add now the unadjusted here, what's the symbol for the 2-year? Can you guys type it in? Everyone except Clemens, because he knows. He's a futures veteran. Clemens is just here to cross-check if I'm not doing any kind of mistake. Guys, what's the symbol? I'm asking. Yeah, but yeah, that's not an answer, Sina. You have it here. Yes, exactly. Right? Why 102? How did you get to 102? All the treasuries are 114 XN, right? Exactly. So this is some easy to derive, right? From these interest rates. So at TU equals 114 XN. All right. Perfect. Well, that's the treasuries, right? And if we just look quickly, it's linked, yes. If I look at TUU, and here just quickly, is it TUU? Yeah, place a market order. Okay, then you see the tick value is $7.81. That's kind of abstract, right? But you see also here, that's why it's always the easiest if you first place an order in the simulator and then you see basically the price movement on these products. Now here you see it's basically a little bit different than on the interest rate. So, but still it moves from 6. You see here from a round number. I would always check, hey, how does it move from a round number to another round number? So here it moves from 110 6 to 110.7, and then it has one decimal, and then it moves 1, 2, 3, 5, 6, 7, 8, 0. So that's spacey. Okay, that's really odd. I've never looked at a 2-year, but you see basically how I would then do it, right? Very much straightforward. I would just then, okay, there's no 4 here, there's no 9, for whatever reason. So it's basically the move is 1. So 1, right? 1, 2, 3, 4, 5, 6, 7, 8. So 8 ticks equals 1 point here in that case. So 8 times 7.81. You can do the math. I just, yes, I guess in 8 steps of 0.20, 0.125 and rounded values. Yes. So, but and then you do the math yourself if you want to place a zone, right? Like we did basically position sizing, like the S&P 500. So cancel, not cancel, close all. And right, and if you go all the way up to the 30-year, you see if I place a market order here, this has the highest tick value, right? Every single tick is $31, right? And then again, you would do the math yourself. From one, so you see here, it moves in 132, right? You see here. So basically 32 ticks equals 1 point. But this is then when you place an order, you see this basically yourself. Close. All right. These are the treasuries. Questions for the treasuries? I think this was very straightforward here. It's just the tick values are a little bit different compared to the other products. So let's now go to, where shall we go? Let's go first to the currency group, because the currency group is also very simple. And then we go into the energy and metal. And energy and metal, we have then obviously more minis and micros available. So for the, wait. For the currencies, we have Australian dollar, British pound, Canadian dollar, euro, Japanese yen, Mexican peso, New Zealand, Swiss franc. The dollar index is then also ICE, right? So we could trade the dollar index if we subscribe to ICE. So we have then all the soft products as well. And we have then the mini euro, mini yen, right? So for minis, we have only the mini euro and the mini yen. And then we have e-micros, which are most probably really micro lots, right? The Aussie dollar, British pound dollar, and the euro US, the euro dollar, basically, right? So again, for the currencies, it's always here Aussie dollar, US dollar, British pound, US dollar, Canadian dollar, US dollar, euro, US dollar, Japanese yen, US dollar, Mexican peso, US dollar, right? For some of them, I repeat that, right? So the last time, for some of these, right, in the spot Forex, it's the inverse picture. For the Mexican peso, it's in the spot Forex USD Mexican peso, inverse picture. For the Japanese yen, it's USD yen, inverse picture. For the Canadian dollar, it's USD Canadian dollar in the spot Forex, inverse picture. And for the Swiss franc, it's USD Swiss franc, inverse picture. But the rest is same like in the spot Forex market. All right. So what we're gonna do is we're gonna add the minis and the micros as well and look at them specifically. But first of all, we're going to check the front month. So therefore, for sure, we can use TradeStation now. And we start with add EC. All right, you see here it's also September, so it's also on September. We should know by heart already. It's U, right? September is the U contract, and the back month we can quickly check, right? But as I can tell you, because currencies I know from top of my head, currencies they roll over similar to the equity indices every quarter, basically. You see here. So the next one is basically here, September. So now, and then U, and then we have also December. So always U and Z, U and Z, U and Z. Pretty simple, right? I forgot something, but let me finish quickly the currencies, just quickly. And then I want to mention something important. ECU21, JYU21, SFU21, BPU21, ADU21, CDU21, MP1U21, NE1U21. Now the back month, ECU21, JYU21, set. Yeah. You see, it's good that you guys are watching, right? I was like already you. All right. EC set 21, JY set 21, SF set 21, BP set 21, AD set 21, CD set 21, MP1 set 21, NE1 set 21. All right. Now you see here also volume, very decent, high. This is the daily volume, right? You could also add here, if you want another column, you could add the volume average. I have here the daily volume, right? Anyway, we're going to add only products that make sense to trade. And you see here also the back month is not being really traded on the currencies, but once the expiration date comes closer, right, when the rollover process starts, then basically the volume is going to shift. So now you see, what have we done already? We have done interest rate, equity indices, interest rates, and currencies. You see here, so far, first noticed date is so far the column here it's empty. On the equity indices, on the currencies is also empty, meaning these markets, they don't have any first notice date. So for you, it's clear when to roll over. So you have to look out for the expiration day, right? However, and this is what I want to jump back quickly, I forgot to mention, for the interest rates, here we have first notice day. You see that? So you see the expiration day for the treasuries is on 30th of September or on 21st of September, but the first notice day is end of August. So the first notice day is earlier. The first notice date is earlier. So what does it mean? What does it mean? Are you guys aware of that? Yeah, you know, you can show off now because I explained you in the last one-to-one session, Zina. Yeah, that's really like showing off because I explained her on Saturday. So let me get to that PowerPoint slide again. It's in the course, right? It's in the course that you have watched the recording. Where is it? I want to find it quickly. 10 position size, cheat sheet. Here we go. So for some products, the life cycle is always kind of similar. You have the first trading day at some point of time, right? And when you have the first trading day, you see on the chart, if you look on the chart, you see basically these dots and a lot of white space. Why? Because the first trading day is very much, it can be like very much in the past when nobody literally cares about this contract. For instance, here the gold the gold June 2017 contract, the first trading day for this, the life cycle start was in 2011. So technically now you could trade a contract that is in the future, maybe gold 2025 whatsoever, right? But would be hard to trade because there is no volume, right? So now on that one, you see this was when the life cycle started. And then if you looked at the life cycle at the chart, you would see a lot of dots, because this means like one contract being traded there, another contract being traded there, whatsoever, but you would never see candles, right? So now at some point of time, this contract becomes the back month of another front month, right? And then you see already candles, right? And this is where you then start basically most likely starting to see candles on a higher time frame. And then it becomes the front month, right? This is where you basically then going to trade this specific contract. Now, some contracts, they have a first notice day before, you see, before the expiration. Last trading day and expiration date is the same. Last trading day and expiration date is the same. It's just a different naming for it. So for some contracts, for some markets, like here on gold, for instance, or on the interest rates, you have a first notice date that comes before the last trading day. So your rollover, you see here, you have to roll over before that first notice day. Because if you kept this contract on that day, you would basically declare to fulfill either buy or sell, here in this case, physical gold, right? And the period from here to here, this is then just basically for the exchange, for the buyer and for the seller. This is the settlement process, but there's no trading activity here. So again, from here, this is where the settlement process happens. There's no trading activity. So if you kept a contract on the first notice day, you say, hey, here, exchange, I declare to either be a buyer or a seller of that specific asset. That's why you have to roll over before, here in this case, the first notice day. All right. And you see that also on these unadjusted symbols, because this is where the alarm bell should go on. If you have an unadjusted symbol with a high number, 120, usually, right? If you look at the indices, it's either it's 103, if I'm not mistaken, right? And or I think with crude oil it's 103, right? And with the indices it's 107, or the other way around. I don't know. I'm always mixing that up. Maybe you can quickly check, right? So you have basically there, there's only an expiration day. So you have to roll over. The rollover process only takes 3 days or 7 days. But when you have a high number here, 20, 14, 17, then all right, there must be a settlement process in between. That's why we have to roll over a lot of days before the expiration. Clear all drawings. And in natural gas, for instance, you have a first notice day as well, but still here the last trading day is before the first notice day. And on S&P 500, for instance, you don't have a first notice day at all. You have only last trading day. So of course you roll over before the last trading day. So bottom line, to keep this very simple, and it's actually really simple, that's why we created this radar screen with 2 columns, expiration date and first notice day. And the day basically for you, it's very straightforward. The day, so if the first notice day comes first before the expiration day, then this is your rollover day, the first notice day. If the expiration day comes before the first notice day, then this is your day where you have to roll over. And if you don't have any first notice day anyway, then the expiration day is the day where you have to roll over, the last day where you have to roll over. Clear or not clear? Everyone else as well, kind of? Right? So you always check the day. So now here on the interest rate group, you see clearly, hey, here it's end of August, here's end of September. So what is more important for you on the interest rates, the first notice day or the expiration day? When do you have to roll over? Notice, perfect, right? Exactly, very, very simple, very straightforward. I just needed to explain this. So, done. Perfect. So, What's next? Yes, the currencies. We stopped with the currencies because now we have to add the currency group mini and micro. So let's, for that, data, nope, data, add blank row, data. How many do we have? How many do we have? We have 2 minis and 3 micros, so in total 5. So I put them in one group. Currency group mini slash micro. The same here. So I put this on the right side of my screen so you don't see it, but I tell you the symbols. So the mini euro is E7. So here it's just a derivative basically. So it's going to be all the same contract letters month, obviously, right? So E7U21, that's the mini volume, 3,000 tradable, I would say. E micro for the euro dollar is M6EU21. All right. Let me just check. Is there a 11839, 18? Oh, they look a little bit. Yeah, we have to plot them in the. Yeah, you have to plot them as the unadjusted as well. Yeah, a little bit different decimals here, as far as I can tell. The mini yen J7U21. E micro British pound US dollar. Oh, the volume here is really small for the day. M6B U21. Oh, why did I hide this now? Oh, and now the last one is D. What did I miss now? The euro, the Aussie dollar. M6A U21. Now, label row here, we have to describe it. Currency group mini slash micro. So here it's of course all set. So E7 set 21. You see it, you have to do this work just once, and then once you have that list, the updating, right, once per quarter is then really, really quick. But that's why first time we do it together. M6E Z21, J7 Z21, 2 contracts, M6 BZ21 and M6AZ21. All right. I think I didn't do any mistake here. I think that's fine, right? Correct. So now here, we have to do this here as well. Add label row. Is it clear now how we gonna plot the unadjusted chart for everyone? What's the one for the mini euro? For the mini euro? Perfect. Are you guys doing it actually in parallel, or is anybody doing it in parallel, or just looking and watching, or doing it afterwards? What's your process? At E7 equals 103xn. CUT data unavailable here, of course, right? At J7 equals 103xn. At M6A equals 106xn. At M6B equals 103. I wrote, yeah. Nobody saw I made a mistake here. Let me at M6E equals 103xn. At M6A equals 103xn. Alrighty, so this is done as well. Tick in the box. For them, because I've also never seen them, let me just quickly. Place an order, a market order. So you see now on the euro, on the mini, the tick value is $6.25. Close. On the normal euro, it's also $6.25, but I think the close 90 to 95. You know, you see here, that's the difference here. For sure, it's less margin requirement. The margin requirement is the margin. That's why I see. The margin requirement is literally half, right? 2, 4, 1, 2. And that's why you have to plot the unadjusted chart as well. And you cannot, and that's why we are plotting the unadjusted, even though for the indices, it's not necessary to plot actually the minis, because the numbers are exactly the same. You can transfer you can plot theoretically, you can plot the at ES and draw your lines at ES and place your order at MES. It's the same numbers. Here we have to plot, and that's what I figured before when I said I think the decimals are different. Here you have to plot the at E7 equals 100 3xn, because that here you see the decimals are different. Here you have the movement from 400, 405, 410, 415, 420, 425. Here it moves 400, 410, 420. So, and that's why here also you have $6.20, but the movement is smaller. Right? So, and on the E-micro, what's happening on the micro lot? And here it's also completely different. You see 1840, 1841. So what is here? And here, you know, sweet $1.25, right? Even for a rookie, right? Who is just getting out of the simulator and wants to have their first trades on the live trading. So perfect to do this on the futures, right? Close. I would be a little bit cautious. I'm not so convinced that we should use the yen. I keep it now in here just for the sake of, because we are plotting now everything, but a volume of 348 contracts per day, I would not recommend. I think even it doesn't. Order type not supported for this symbol. You see TradeStation, that's why volume is so little. It doesn't let you. You see here, this is all blacked out. You see the radar screen. When the radar screen is blacked out, either you did something wrong with the symbol, or TradeStation doesn't let you place an order here in this case. Now you see that blacked out. TradeStation doesn't let you place an order. The volume is very small, so no trading on the mini yen here. But I think everything else, yes, of course, you have here high volume on the micro Aussie dollar, on the micro British pound dollar, and high volume, okay volume, not high, not high volume, right? You cannot compare like to our interest rates or to the equity indices, but still, it's okay, right? To trade one contract here, two contracts there, three contracts, that's not a big deal, right? And we also trade not 60-minute zones for daily zone whatsoever, for weekly zone. That's also fine, absolutely. Cool. Questions for the currencies? Can I check something on the futures sheet? What do you mean? You mean this one? Nikkei is 103. Oh. All right. So now let's go to just checking the time. Okay, 30 minutes more. We definitely finished the at least the energies and metals. So now, oof, that's a lot. So metals, gold, silver, copper, palladium, platinum. Even though I doubt that somebody is going to trade palladium, but for the sake of exercise and plotting it, so we have all of them in the list. Um, we plot them. Micro gold, interesting now, right? E-micro silver, interesting as well. The minis you cannot use because the minis are ice for now, right? And then we have the energies, crude oil, natural gas. And then they are really interesting as well. Heating oil, gasoline, Brent, we cannot, it's ice, low sulfur, gasoline, who cares, ice. And then we have the E-mini, crude oil, natural gas, heating oil. These are all E-minis. And one micro now, just now, I don't know, couple of days old, basically, the micro crude oil. Yeah. We put the micros and minis here in one list, or how do we do it? So first, let's do first energy metals, the normal ones that we have already here, basically. So crude oil, ladies and gentlemen, crude oil, I want to show you now on bar charts. Oh. So crude oil or natural gas, for instance, and also gasoline and heating oil, they are rolling over every single month. You have August, September, October, November, then you would have December, and then January 2022, February 2022, and so on and so forth. So here you have to roll over every single month. So now an advantage that we didn't mention so far compared to trading these CFD futures or any kind of CFD that you have to roll over every month, because there you have only one contract to choose from, right? They give you just, okay, that's the front month, that's the one that you can trade, you cannot trade anything else. So they make it just to simplify your life and not to get not to confuse the heck out of the retail trader, because they have no freaking idea. Hey, back month, front month, couple of more back months, and whatsoever, right? You as a professionally trained futures trader, if you trade futures and if you planning to trade a monthly zone, for instance, or weekly zone, and if you're planning to stay in this trade for a longer period of time, you can choose to trade a contract that is in the future, right? And if you look at here the volume, we can look the volume, we see the volume here. Crude oil, all their month in the future, the next 4, 5, 6 contracts in the future, they have all decent volume that you can trade, because that's what professionals are doing. That's what institutions are doing. They don't bother about rolling over every single month. You can then just trade if you plan to keep the contract anyway, or if you're planning, you never know, right? But as a weekly or monthly income trade to keep it for several weeks or month, then instead of trading CLQ, you just trade CLV, and then you basically are set for at least 2 months, and you don't have to bother about rolling over and closing, opening a new position, and so on and so forth. So this is, I think, another advantage, especially for weekly and monthly income. Does this make sense? And this works. And you see, this doesn't work for contracts like that are quarterly rolling over, like the interest rates or equity indices or currencies, because you stay in the trade for you can stay in the trade for a whole quarter, right? And the back month doesn't have volume whatsoever, and you cannot even trade that. But for a contract like energies that roll over every single month, you can trade the month also that is in the future, not only the back month, but also the month after the back month, just basically to avoid the rollover process. And then you just select that contract that you want to trade, and then you are also pretty much set, right? So now, we checked for crude oil, CLQ and CLU. CL. So for most of them, I know that from top of my head. CLQ21. So natural gas, by the way, not just that we don't always have to, now the process, you would look at bar chart, blah, 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 right? So now natural gas, same animal than crude oil, it's also rolling over every month, right? So it's NG up and GQ21. This is always 28th. So now you have to check. Look here, crude oil. You have a first. Okay, you tell me now. When do you have? What is more important on crude oil? What do you have to pay attention to the front, to the first notice day, or to the expiration date? Which is your important day that you have to look out for to basically say, okay, this is the day you have to roll over on crude oil and on natural gas? Perfect. Yes, expiration date. Thank you, guys. Perfect. Expiration date is before, right? Expiration date here, 20th of. Yeah, exactly. Yeah. Perfect. Great. Great, great, great. That's what you do, right? You always take the date that comes earlier. You have here too. There's no doubt. There can be no doubt because you take the date that is earlier. That's the clarification on that issue, right? Even how should I know from top of my head, right? So I just, okay, which date comes first? Okay, that's my date where I have to roll over. So gold, we should all know because we are trading it. We are also in August. Silver, we should also know, right? In silver, what are we trading in silver right now? You're trading Q? Isn't it U? U, exactly, right? Yeah. So copper and palladium is also U. So I'll just show you, right? You can check it, of course, in copper. Then we would go to energies, we would go to metals. I just did. You see gold, right? Q, silver, U, copper, U, platinum, V, palladium, U. You just have it very nicely on bar chart. So I just put it here on the right on my screen. So anyway, very simple. Copper, what did we say on copper? HG. HGU 21. Palladium PAU 21. Platinum PLV 21. Heating oil HOQ21. And I want to add one more product here. That is the New York Harbor blend stock gasoline. That has also really actually decent volume and it's nice to trade. R, B, we are in Q because also these things, right? Heating oil, gasoline, crude oil, natural gas roll over every single month. 21. Boom. All right. Now the back month. That focus here. So CLU 21. NGU 21. GCV 21. So what about gold and silver, ladies and gentlemen? First notice day or expiration day? As I said, 21. HGC 21. Perfect. Right, you see here on these energy and metals, you really have to watch out. They have all first notice day. There you always have to look, okay, which day comes first? Okay, the day that comes first, this is my rollover day. Or this is where the period starts a couple of days earlier. Palladium. PAZ 21. PL. Platinum is already F22. Heating oil. HOU 21. And last but not least, RBU 21. Boom. All right. Great. Great. So what's next? So let's do now the following. Let's look at the energy group mini. And then we do, because we have minis, we have crude oil minis, natural gas mini, heating oil mini, and gasoline mini. All right. And then we have energy metal group micro, because we have gold micro, we have silver micro, and we have crude oil micro. So let's look at all of them and see if they have volume or not, and if they are tradable, these minis and micros, right? Because again, this is what this exercise we do for the first time together. Well, if this has a lot of slippage, you see, because it jumps back and forth, just looking at the matrix. Well, if you would anyway place a daily look, exactly, you look at the matrix, right? Now, that's I know this is, but this can be, it jumps back and forth, but it's most probably misleading, because if you would now look, we have to first by the way, we have to add the product here. Add RB equals 103xn. So you see all energies, by the way, all energies 103xn. But you find this on the, to create the symbols, right? That's on the cheat sheet. This is on a cheat sheet, this part. Or this is something that you are in the, I'm not sure if it's on a cheat sheet or is it available for downloading, but it's definitely in the futures, it's in the futures course. So you see basically here, gasoline, the XN value here. And you see for all the grains, it's 10, for lean hogs, 07. If you wanna, if you have to construct your own unadjusted chart, this will help you, right? And then you have this one as well, where you need some for gold, some, oh, that's gonna be messy. some for the e-minis and micros, where you need these contract month, where you have to add the single month, because there's one black sheep inside these one contract that is not, that historically doesn't have volume, right? So, but this is what you need for that. So where are we now? Look, you say it jumps back and forth, back and forth. You would anyway look, if you look at the daily chart, looks like also seasonality wise, it's holding tight. You would anyway look on the, if you have a zone like this that is massive, there you don't really care, right? I mean, 200. Let me go a little bit higher. Let's assume something like this. 217 to 20. Let me look at the matrix. 217. If I can even find this on the matrix. You see, like, that's these daily zones. You know what I mean? These daily zones going to be big. So on the you don't care about the jump from here to here. You don't see this on the daily, basically. You know what I mean, Clemens? A daily zone is most probably bigger than from here to all the way here. You know, like it's going to be a lot, longish. Yeah, yeah. That goes from 300 here, 300 to 3060. You see that little bit? That's almost the entire matrix. You see, so then you don't care about that move, a little bit slippage there up and down. That small thing here is literally half of the matrix. No, 3060. No, it's the whole matrix here, this part. Right, so makes sense? So you don't care about these jumps here. Anyway, you want to avoid looking at the matrix because this makes you really cuckoo, right? So where did I stop? So now I'm a little bit, I'm confused. What did I want? Yeah, I was like adding, just checking again. Time, okay. data at blank row. How many? We have 4. And we do the energy group. And we call it mini. So we have 4 minis crude oil. So it's always crude oil is QM, right? QM. Yeah, the symbol is going to be the same. The contract month, but the symbol itself is QM. The contract month obviously the same, August 21. Natural gas is QN. QN Q21. Right? You get this from the TradeStation website again. Heating oil, mini QHQ21. Oh, wow. Okay. We keep it in just for the sake. Q21. Oh, what a bummer. Okay, anyway, we have the real ones. And here we have all our U. U21. Q and U21. Let's see if the back month is being traded. I doubt. QH U21. Yeah. Q U U Q U U. Yeah. Q U U. Also. So let me currency group. All right. And now, and then we finish off. We do for today, we do the energy and metal group micro. These are only 3, but they are for sure, they have volume. E micro gold, E micro silver, and micro crude oil. And tomorrow we add them here in the unadjusted charts. I wanted to have blank roll. 3 of them. A lot of work in the beginning, but you do this once. So now we call this energy and metal group micro. Energy and metal group micro. Energy and metal group micro. All right. What do we have here for gold? MGC. Oh, that's easy. MGC, and then of course the same contract month, Q21. MGC Q21. Silver, SIL, same contract month, U21. And crude oil is MCL. MCL, of course, same contract month, Q21. You see all of them decent volume. Back month, GCV 21. Silver SILZ 21. Crude oil MCLU 21. Amazing. So now we have this as well. And now we just look at crude oil quickly. So if a crude oil you see here, the crude oil has the most volume out of this whole energy and metal group, right? More than gold, more than silver. It's a lot of volume here on crude oil. Now, here you see, let me place a market order. So the tick value on crude oil crude oil is and always was $10, right? So, and it moves like crazy. You see now I lost $100. I'm stopped out. You see how quickly I lost $100 in a simulator, right? Did you see? One contract, bam, gone, right? Lunch money gone. So now on E-mini, we see also it's a little bit different. Let's see. So you have to have the unadjusted as well. It's $12.50. It's even more, but it moves. You see here, but you see it's more. But you see how slow it moves. So you see also the numbers, the decimals. Are different. Organic chicken breast. It's also like freaking expensive. All right. So look at this. You see, crude oil is not my day with crude oil, right? But it's dropping. So so you see, let me close it. Anyway, getting stopped out here. No, it's not hitting my stop. What the heck? Okay, let me close it. And on the micro, so here, let's see. On the micro, we go short, right? We sell market. You see here, micro, $1 move, and I'm making money. Cool. So then now you have the minis, the micros, and the normal standard crude oil contracts here, right? And tomorrow we add them here in at the unadjusted, on our unadjusted list. Again, I want to explain why we use certain here. We don't use certain letters for some of them, for some of the products or certain contracts. We basically remove from the equation, from the chart. Before closing today, can you please remind me where to find the dollar value per contract for each product market? The dollar value per contract. Tick value, or what do you mean? Tick value? Point value, margin requirement. Margin requirement you don't find in the course material, because the margin requirement changes so frequently. The margin requirement you find always here also on a TradeStation. You remember when I said, when I started off trading NASDAQ, the margin requirement was 4,000. Now it's 17,000. No, that's the margin requirement. That's the contract price, right? So now if I place one order, if I buy one contract of the NASDAQ by market, what now? You see how quickly it can stop you out. What the heck? Let me sell one contract. That's why offset has always, okay, let me do the offset first. Offset. You see how quickly this thing moves on the matrix. Offset has to be 50. So now sell it. So position, my total cost for this position, you see here. Do you see that on the screen? Everybody sees that? So that's my cost to open the trade. So that's my margin, my initial margin. Tomorrow it changes to 16,000 because it's you have to keep the maintenance margin. But this is in the course, this is explained in the course, right? Initial margin to open the position. If you keep it overnight, then you need less margin, but it's just still just a little bit less. All right. Does this answer your question? And these are changing frequently. So you can always place a trade in the simulator. You see it here. Hey, what's my cost? What's the cost for a contract? Or you check on a TradeStation website. You see, okay, what's the margin requirement? What's my deposit, right, to open that trade? And these values have to be the same. What's so? What's the problem? To open a trade on a NASDAQ now, you need $17,600 in your account. Now, if you have $20,000 in your futures account, you can trade one contract of the Nasdaq. So you have remaining. So if you open a position now of the Nasdaq, the broker blocks these $17,600, and what you have left is $2,400 remaining purchasing power. Now, if you get stopped out at break even, you get back these $17,600, right? And you have again $20,000 in your account. Let's assume you lose $1,000, then you get back $16,600 from these 17,600. And if you make $1,000, you get back $18,600. But we can cover that on Saturday again in the one-to-one session, right? Slowly. But that's basically always the money. That's your deposit to open the position. That's the amount that you need to have in your account to open a position. That's why I just said, who would trade Palladium, right? To open one contract, you need at least $34,000 in your account to open one bloody contract of Palladium, right? This is just a deposit, yeah, security check, however you want to call it. But the cost in general, you don't have any costs. The cost is the commission, the $1.20 opening a contract and the $1.20 closing the contract. That's your cost. That's just a deposit. If you make money, you go home with the deposit and the money you made. If you lose money, X amount, that X amount gets deducted from that deposit. The cost is basically just in futures, the only cost that you have is closing and opening the position. And that's per contract. Here, what we see in the simulator, $1.20. So opening, closing is $2.40 in total, which is chicken shit. Deposit to open a position. If you have $30,000 in your account and you want to trade one contract of Palladium, TradeStation says no, because you don't have enough margin in your account. Well, potentially you could, because you have day trading margin. But we should maybe cover this tomorrow also, right? Because 50% of initial, right? But this is also covered in the course, right? This day trading rate, that you have a day trading rate. But this means you have to close it on the same day. So potentially, right, you have for certain products, you have a day trading rate. And this is also listed here for certain products, but we're not day traders. So that's why I don't mention, I mentioned it in the course, but I would not mention it here necessarily because we are not day traders, right? We don't keep position only for one day. But theoretically, if you trade the S&P 500, let's make it simple for my mind as well. For Palladium or for gold, right? If you open that position, right? You can open that position with $5,000 in your account, because the day trading rate is 50% of the initial. What is the initial? Initial margin. So $9,900 divided by 2, right? 50%. So $5,000 roughly you need to open that position on gold. However, you have to close that position on the same day. If you don't do that, the broker will close it automatically if you don't have the entire 9,900 in your account. Right? That means day trading rate. I will not focus on that because we are not day traders. Right? So yes, but the cost deducted equals cause you get leverage. Of course you have leverage, right? That's why you have these high tick values and point values. So if I buy one contract now of the, you see now, if I buy one contract of the Nasdaq, my market value is actually 300,000 US dollars. You see that? It's like I would buy stocks now if I buy the Nasdaq as an ETF with 300,000 US dollars. But you only paid as a deposit 17,000 US dollars. So is the leverage that you have. That divided by that is the leverage. Like, what is the leverage? 18 to 1 or so, not even 20 to 1. So you could buy the Nasdaq as ETF without leverage. You would need $300,000 in your account, and the movement would be exactly that here. 5, 10, 15, 20, bam, 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 bam. So if I had now, if that was an ETF, I would need freaking $300,000 in my account, and that would be exactly the same movement. I would be now up $50, $55. But now, since we have the futures, I use leverage, I only need $17,000, right? So leverage of 18 to 1, 17 to 1, and I only need $17,000 and I have the same effect. And now I make all the money back today that I lost today in the simulator. Bam. Lol. Yeah. And you see how fascinating that is. I could look at this all day. This would drive me. And the green one, right? The green matrix, I could look whole day. Yeah, but only if it's green. The red one hurts. Yes. Cool. Is it now clear for everyone? Good question. Does this make sense for everyone? Super clear, everyone? And you have that here, like market value, total cost, that divided by that is always your leverage. And you have that for each and every product and listed here, right? Thank you. Firas, perfect. Dan is perfect. Thank you, guys. So I leave this position open, right? It hits my target, $250, more than lunch money. Otherwise, I can go out and have a nice dinner. So, guys, I wish you guys a very good evening, and I'll see you guys tomorrow evening, right? Perfect. Have a good one. Bye-bye.